Hey, how's it going, everybody? Mike Weber here, your Los Angeles real estate broker, here with your real estate market update for November 2023. So what's happening out there in the real estate market right now? Interestingly, although not much in some ways, in other ways, an awful lot. We are, of course, still seeing kind of the same similar trends in terms of low inventory and high interest rates, not a lot of activity, things like that. But some notable things that have happened in the last month would be interest rates hitting a multi-decade peak. They've kind of come down off those highs, but they definitely broached the 8% mark. They were above that last month. And so far, they've kind of come down somewhat. But I think the interesting thing in regards to interest rates, which ultimately are really the driver of real estate prices and real estate activity, particularly because they were so low for so long that so many people either bought during that time with low rates or refinanced into low rates, that there's this huge movement of wait and see because everybody thinks that next year is going to be better, or a year or two is going to be a better time to transact real estate because people think rates are going to go down. Everybody is anticipating that the Federal Reserve is going to lower rates. Most people think they're going to lower them probably early next year, maybe middle of next year. But here's, I think, the curveball that most of the market maybe doesn't anticipate and that most people definitely aren't talking about. We obviously have this out of control debt problem in the country. We've been printing trillions and trillions of dollars over these last couple years, really starting to accelerate as a result of COVID. And what's happened is the most recent Treasury auction that we saw pretty weak demand overall, and we saw a lot of indicators that the market in general is no longer going to be willing to absorb this US debt at the interest rates that are being offered, obviously because inflation levels are so high and likely to remain persistent for so long that investors are going to want to be compensated adequately for taking on risk of loaning money to the US government for 10 years or 30 years or whatever the case may be. So we could end up having a problem on our hands in that the Federal Reserve wants to lower rates, but the market is not willing to buy our debt unless the rates are higher, and rates could get pushed up by the market, which could leave the country in a very dire scenario with only two options. Option one being yield curve control, which would be something similar to what we saw happen in Japan for a very long time, where they essentially just print endless amounts of money to try to force interest rates down and essentially become the buyer of last resort for US debt, which ultimately will most likely lead to out of control spiraling inflation. Now, under that scenario, it is possible that rates could go back down, and that would obviously be their goal. But at the same time, we could suffer from extreme inflation for a long period of time. So who knows what that'll do to real estate prices if that were to happen. Now, the second scenario that could end up happening, which I think is very unlikely given the circumstances, kind of what we've seen, the political ramifications, etc., would be to keep rates higher for much longer, potentially even a lot higher than they are right now. Obviously rein in some of this out of control fiscal spending and try to right the ship before it becomes something much more catastrophic. So either way, there could be much bigger implications than I think markets are anticipating right now in regards to real estate. And it could turn out that waiting another year or 2 more years may not be the best decision that everybody thinks it's going to be, given what may end up happening as a result of these issues that we're facing right now. That all said, let's go ahead and jump in, take a look at the data and see what's actually happening here in our local market in Los Angeles. Oh, by the way, if you haven't subscribed, go ahead and do that now. Leave some comments down below. Let me know what you guys are thinking or what I can help you with in regards to real estate. And let's go ahead and get started. All right, so looking at median prices in Los Angeles County, we see that miraculously we're up about 6.2% compared to a year ago. We're almost at the all-time record peak for the county of Los Angeles in terms of median prices. And to some extent, this kind of defies logic, right? Because we have these really high interest rates, somewhere in the vicinity of 8%, and yet somehow prices are still rising or remaining very high. And most people would think, oh, well, if rates are so much higher, shouldn't prices be going down? And yes, they should be going down if there was an adequate level of inventory and people out there willing to sell their homes. Then we would expect, as the inventory rose, ultimately, because the rates are so high, a lot of those homes would not be being bought, and so the prices would need to be lowered in order to get people to buy them. But of course, that's not what we're seeing. We're seeing very little inventory out there because everybody wants to wait or isn't sure what to do. They're hoping rates are going to go down, and as a result, the homes that are getting listed are still selling at relatively high prices, even in the face of relatively high interest rates compared to the trend that we got to experience for the last 10, 15 years, whatever it's been. Now, when we move on to closed sales, we see we're down 5.7% year over year. So it doesn't sound that bad, but of course, if you look at the chart, you see that that's because last year was already starting to trend down by the end of the year. So overall, very little homes that are actually making it to the closing table. Not a lot of activity overall happening out there in the real estate market locally. And here's where you can really see kind of what I'm talking about. When we look at pending sales, we're down about 24% year over year, sitting at around 27 homes being sold for the entire county. Now, around this time of year, in a typical year, say 3-4 years ago, which even back then there wasn't a lot of inventory, I would say the level of activity at this time of year was roughly double. So we're seeing about half the level of activity that we would have seen even a couple of years ago, when, obviously things were somewhat subdued and there wasn't that much going on. But of course, it was substantially more than we're seeing right now. And lastly, I just want to show you guys how many active listings are out there. If you've been out there shopping for a home, you probably know there's not a lot out there to look at. There's very few signs up. We're down about 30%, 28, 29%. From a year ago, and you just see this trend, this pattern where the active listings, the inventory just keeps on going lower and lower. So it's really going to be interesting to see what happens. I think when the Fed decides that they want to go down in interest rates, what the market's going to actually demand as a result of this inflation and the worsening fiscal condition in the United States. Also, the U.S. credit ratings just got downgraded by the ratings agencies, so this is not a good sign. So we have a lot of potential catastrophic economic things going on right now, and who knows how those things are ultimately going to bleed over into real estate, whether or not the Fed will be successful at getting these rates down if that's what they attempt to do, or if they're going to keep them high and we're going to have to do something about this spiraling debt. So obviously, I'll be following it. I'll be watching it. If I can help you guys with anything at all real estate related, give me a shout. I appreciate you guys watching. Hope you're doing well, and I'll see you on the next video. Take care.